Welcome to the Spirited Agent Podcast. We're pouring wisdom and sipping success one episode at a time. The Spirited Agent was created to empower agents to navigate the ever-evolving world of insurance and grow their business. Grab your glass and let's get inspired to protect your clients from the unknown. Here's your hosts, Millennium Brokerage Group Legacy Planning Executives, Jason Combs and Matt Zelenin.
You know, if you were a physician starting out today in a perfect world, like let's say you're going into medical school, walk me through what your thought process would be from a protection standpoint.
As a young physician, you're making a big investment in your career. While you might not have a lot of income or disposable means to pay for some of these things, I would say it's critical to at least have some basics, some things like some core disability coverage. You can get that at a very inexpensive price as a young medical student or resident. Term life insurance as you maybe get a little further down your journey, and then obviously the professional liability. But all of those things are very, very important. The other piece of that is the advantage of not only protecting yourself, but doing it at a younger age where your insurability can be maximized. And what I mean by maximized is you're more likely to get the coverage you want at a better rate than others might if you wait for a few years. And so I think there's a combination of getting the coverage, leveraging your insurability while you can. What do they say? You're never going to be as young as you are today, and you're likely not going to be as healthy as you are today. And so maximize that while you can. So to me, those are the core building blocks. And then what we often see is as people obtain those and get those things in place, then they move to other types of questions like, well, what should I be doing to be a little maybe more sophisticated in my planning? What other kinds of uses for life insurance, annuity products, planning? That starts to bubble up at that point in time.
There's 50% of Americans that don't have any type of individually owned life insurance. And even the ones that do have life insurance are saying they don't have enough life insurance. When do you stop and get gas?
When you're almost empty.
When you're almost empty. That's the biggest challenge when it comes to the life insurance. I think intuitively, people know they need it, but it's a timing issue.
Well, once you truly need it,
it's too late.
Yeah, it's too late.
Right. When you walk out of that doctor's office and they say, hey, look, you've got something wrong with you.
Yeah.
That's when typically that insurance agent gets the phone call.
Mm-hmm.
Take 10 minutes to understand your options versus delaying it for 10 years. Because that's what most people do. It never gets high enough on their to-do list to do it. And one of the big things is that people, they overestimate what the cost is. My son, just bought $1 million of term life insurance, and it costs $30 per month. I mean, that's literally the cost of you and your significant other going out to one lunch per month. The other thing is that they don't know what type of insurance to get. There's a lot of questions about that, but there's always this thing of getting some insurance in place now. I think most people look at it as a thing where they've got to get everything figured out in one meeting. Well, that's not necessarily the case. You can buy something today and build off of that next year and the year after that. So, making sure you get something started now is a better decision than just postponing it. And, at the end of the day, the real question is if something were to happen, how's your family going to continue?
It'd almost be better if people treated it a little bit more like home and auto. Like if you buy a new car, you say, hey, I bought a new car, please delete that one, update me to this new car. You put a pool in your house, you now have to get more insurance to cover the pool, trampoline for your kids. But people kind of just either do or don't purchase life insurance and I set it and forget it. But it is one of those things, if you only want to pay X amount, a lower amount, put some in place and then 2-3 years revisit it. So when you put it into perspective how much everything costs nowadays, the protection for you and your family, if you're spending $200 a month on a life insurance policy, that's still less than I spent at the grocery store on Monday, and I'll be going back again tomorrow.
Right.
So relatively speaking, in the era of inflation and everything we got going on here, it's not that expensive compared to what you're buying on a daily basis.
Well, you bring up a good point with inflation because, we just went through an area of inflation, right? An era of inflation.
Mm-hmm.
And I mean, in essence, everything has doubled in price, right?
Yeah.
So, but I would bet you that most Americans and most physicians didn't double the amount of insurance. And I'm not necessarily suggesting they go out and double their amount of insurance, but it's probably a good time to take a look at what it is you got and see if there's some gaps.
Well, and I think that's the problem for a lot of people. You take physicians who are as busy as they are. If they take the steps to purchase the coverage they need, it's kind of one and done. It's done, move on, and no one thinks about it.
Right.
But what people should start to do is think about either an annual planning process or at least every couple years to go through that and to reevaluate. Matt, you mentioned auto and home. People shop their auto and home coverage all the time.
Right.
But yet they don't take the time to think about what kind of coverage, Jason, to your point, that they actually need. But the other aspect is your insurability. And if your insurability goes away, price goes out the window because you're just not going to be able to obtain the coverage you want. I've got an example of a young family friend who was a college baseball player and healthy as a, and all of a sudden he was told he had a heart condition. And so now it's going to be really challenging for him to obtain any coverage, let alone at a good price.
Right. Years and years ago, I went to the Midwest Anesthesia Residency Convention. That's a mouthful. But it was up in Cleveland, and we had a little booth, and we were just talking insurance, and I was talking mainly disability. And I remember one of the guys I was talking to said, yeah, I had a buddy, actually last year, he went on a missions trip, and he was in a top bunk, and I guess he rolled over in the middle of the night and actually rolled over and wedged his hand in the bunk bed and just broke his hand pretty bad, had some nerve damage, all that. And all that to say, things happen overnight that you just cannot see coming. And that just really affects your insurability. You're overnight, you go to like, well, if you can get it, your hand's excluded or, heart condition, you're now looking at a problem with life insurance for life. You can probably get it, but you're paying 3, 4, 5, 10 times as much as you were if you had it right before that. And that's always the hindsight's 2020. So we're not ragging on anybody who, what didn't have insurance and had a health issue. It's just insurance at its core is protecting from the unknown.
One of the things that I see quite often in this business is to the point you made earlier, Mike, and that is people view their life insurance as a one and done type of deal. I got it, so I'm good. But then, the big thing there is, 20 years goes pretty quickly. So you buy a 20-year term, at 30, next thing you know, you're 50. And now they come and they say, all right, well, my insurance is running out. I need to buy some more insurance. And then the next thing they come back with is, wow, it's quite a bit more expensive than what it used to be. And typically they're looking for the exact same coverage that they bought 20 years ago, which is probably not sufficient for, because of inflation and the cost of goods and everything else. And most people still have a lot of obligations, even at age 50. The kids may still be in college and stuff. So to the point there is if you kind of, make an effort to review it every 4 or 5 years, you said maybe even a little more than that, but if you bought some additional term insurance every 5 or so years, you kind of build yourself a little bit of a laddering strategy. So it's not just a one and done, hey, it's gone. It's gone with, I got to replace it all. It gives you the ability to kind of layer it in, and it expires at different times. And then there's also, life insurance has conversion options. And so that gives you more built-in conversion where you can actually convert. Maybe you don't convert it all, but you can convert. Most companies allow you to convert a piece of it. So it gives you a lot more options in the way you go about it. Because people are actually living longer, the insurance company has to revise their mortality tables every so often. And, right now we've got a little higher interest rate environment, which most people don't really correlate interest rates with insurance. But you got to keep in mind, insurance companies and take your money and they invest it in with the rest of their money. And so interest rates actually have a big thing to do with the cost of insurance. So we're actually seeing the cost come down a little bit in different things. So it's a good time if you haven't to review what you got.
There's been a lot of revised rates and everything lately.
Right.
One thing people don't really think about, and especially physicians, and this is not a knock on them at all. They are the doctors. But a lot of times you're kind of at the mercy of these underwriters at these companies, and physicians a lot of time are like, yeah, I have sleep apnea, but it's completely controlled. They understand it better than anybody, but the underwriter at that carrier is not looking. They're looking at it like, what is the probability? They've been put into a new bucket because they have a certain condition. So I think underwriting kind of is become tougher for people as well. Have you noticed anything along those lines?
Oh yeah, the insurance companies are obviously concerned and take, I think, a deeper dive into someone's health.
I think technology's
helped. It's a delicate balance, and it's, if you're young, healthy, and highly insurable, great time to make that decision. So what you just described, Matt, isn't even part of the process. And you think about the financial health of maybe your family situation or your portfolio, and then you compare that to your physical health. Well, your physical health, you're typically getting an annual exam, right? An annual physical, an annual review. But no one seems to do that on the financial piece, and yet many will say they're both very, very important. So maybe even if it's not annual, if it's every 2 years, every 5 years, but to make that as much of a priority as you do your own individual health, because ironically, the two kind of go hand in hand.
Your basic protection insurance is really the building block of a financial plan. It's the starting point. You can't build on top of that until the basis, your foundation is laid, and your basic protection is part of that foundation. And there's been studies done that, you talk about relating the physical health with the financial health. There's a lot of studies done that suggest if you don't have your financial health in order, that it's hard to live a happy lifestyle because intuitively you feel it, deep down, you don't have your stuff taken care of.
I know for me personally, financial stuff probably adds the most stress immediately off the bat. You pay a big bill or something, and whether at the end of the day it actually hurts me or not, in that moment, the anxiety and the stress is setting in.
Right.
An hour later, I'll probably be fine, but I can feel it immediately.
There's studies that are done that say people that have guaranteed paychecks, whether that's from a pension plan or whether that's, maybe part of it, that's Social Security, or they got a lifetime payout from an annuity. But those people generally live longer and they're happier because, that's less stress, which is the point that we all made. So buying those basic protections that protect your family, protect your paycheck, that's a lot of security. And we just kind of established just pennies on the dollar. And not even really, it's not even pennies on the dollar. I mean, before this deal, I ran $1 million of term life insurance on a 45-year-old. And you're really talking less than 2% of 1 penny for the coverage that provides for your family.
Well, for the most part, those insurance premiums really haven't been hit by inflation either. I mean, I haven't noticed. Have you noticed premiums go up from what they were, 4 or 5 years ago? I haven't. They've gone down.
They've come down, right? And that is, partly because people are living longer. We just, so your mortality is spread out for a longer period, and the higher interest rates that we talked about. And it's a very, the other thing, it's a very competitive marketplace, and so it's not priced in a bucket. It's priced against competitors, and I think overall the premiums have come down. Years ago, I worked with an insurance agent that sold a lot of life insurance, and one of the things, I just said it there and it reminded me, but he would always segment what's the premium for your coverage and what's the price of your coverage. because in his mind it was two separate things, because you pay a premium to the insurance company to have the coverage, but the price is what that does for your entire family, your entire planning process. And he used to say the price was also based off of your health, which is a point that we've made here too. So at some point, that price is going to be driven up by your ability to actually get that insurance.
Yeah, it might actually be the largest, most meaningful purchase you make in your lifetime that's predominantly based on your own individual health.
There's no way that you can increase your net worth. Your net worth at your passing, agreed. Yeah. It's not your liquid net worth while you're alive, but your net worth that you can pass to the next generation. There's no single way to increase that any easier than buying a large life insurance policy.
Well, we've mentioned on this podcast before, if you buy a permanent policy, I mean, where else can you buy a guaranteed lottery ticket? If I pay $50,000 and I get $500,000 guaranteed to my kids.
Right.
There's not many deals where you can get that. I can't think of any.
Well,
the downside is you have to pass away to get it.
If I were to come to you and say, all right, Matt, I'm gonna give you $1 million, but the catch is that I'm gonna ask you to pay the management fee on this $1 million for the next 20 years. Because in this country right now, if you were to go to a professional investment money manager in the marketplace, the average cost for that is 1% a year. And so, but if I were to say I give you $1 million, you just got to pay the 1%. What would you?
Sure.
I mean, why? Right?
Yep. Well, sign me up.
Now, what if I said, well, instead of making the check out to the money manager, I just make that check out to the insurance company. Are you still willing to make that same deal?
I don't know why it's the same deal, but people were like, well, I don't have it now. Somebody else gets it. And so therefore the whole thought process changes.
Up to probably mid-50s. Yeah. You can buy a permanent life insurance policy for less than 1% of the total face amount. Yeah. So per year. So 1% of $1 million is what, $10,000, right? So that's what you would pay your money manager to manage $1 million for you. You could buy $1 million of permanent life insurance. And so the question that I have is, how does that change your overall portfolio in any capacity? If I had that $1 million that I know is going to be there for my family, if in the event that I'm no longer there, which Theodore Roosevelt once said, the only thing certain in life is death and taxes. So you're going to die. Life insurance is paid immediately. So you're taking that death certificate to the insurance company. They're writing you a check within 4 or 5 business days.
We've also talked about the flexibility it can add to your life before you pass away, knowing that it's being passed on.
Allows you to take more risk if you want to.
More risk. Purchase that new car, purchase that beach house, have more fun with your family. It kind of buys you less stress in the time you have left. I mean, it buys you options. Right. And it's how you look at it. I mean, it's not like you purchase a policy and you're just gifted options right then and there. What would you like to do with the extra money you got? But it's your outlook on what it can do for you after you've purchased it.
The introduction of these living benefits have considerably changed how those work and how they can be utilized. And to your point about waiting till you die, not always the case now with a lot of these policies.
If you're terminally ill, they'll pay you the benefits ahead of time.
Or chronically ill.
Yeah.
Or long-term care.
Yeah. There's
or critically ill. So there's a lot of different definitions out there. And, the older I get, the more I see it with the generation that's older than I am. I mean, you could have saved a lot of money, and I've got some very specific things within my family where, they're well-to-do families that have done very well for themselves. They've invested well. But I tell you, the health crisis in this country is giant, and it's not being covered by the media. If you go, we're here in Nashville, Tennessee, and Vanderbilt is a bit. You walk into Vanderbilt on a Thursday afternoon and look at the number of people in there. So you better either figure out how to get yourself a lot of long-term care coverage, or a lot of life insurance, Because when it comes to your health, you're going to spend that money to stay alive as long as you possibly can. And these healthcare costs are eroding people's savings very, very quickly.
Yeah. Yeah, we go back to the theme of making informed decisions. It's interesting how many people you talk to when they discuss the needs for long-term care, how many think that the government will just take care of them because they're not informed and they don't quite understand how that's all going to work.
If you die, when you die, you know, what's the dollar amount Social Security will pay your beneficiary? Does anybody know that number?
I mean, by the time I die, it's probably going to be this much.
Was that 300 or
no? That was zero.
That was a zero. Yeah. What do you know what it is today? Pretty close to what you just said.
Oh God, yeah.
It's less than $500. It's like $450 or $455.
Oh,
I mean, and the average funeral right now is closer to somewhere between $6,000 and $8,000.
yeah, I was saying.
So you know that's not even. I mean, $450. That's not even covering your transportation to the funeral home.
No, that's not paying the gas for all the vehicles in the procession. If people liked you,
not your vehicles. Right.
Let's get into a little bit about disability. Mike, you want to give us a background kind of on how the AMA got started with disability and what you guys do from that front?
Sure, I'd be happy to. We've had a disability plan a long, long time. 1974, we introduced our first plan. At that point in time, there was a third-party administrator that offered the plan. Our agency wasn't formed until 1988. So for a long period of time, we used an outside firm really to help us market and offer the product. But it's been the AMA's plan for a long, long time. One of the unique pieces of that is it is a group policy. We issue certificates. Doing it that way has helped us maintain the pricing when the plan performs well and we have a lot of positive momentum with it. We can pass along the savings to our physician clients. We've always offered the coverage, so there's this continuation and history of offering the coverage. Two, we have a history of offering savings associated with the coverage. And then third thing I would say is we've been able to enhance the plan over time. So having control of the plan, having it as a proprietary offering has put us in control and it's been a nice advantage for us to be able to make some tailored changes to it because, again, we only offer it to physicians.
In addition to that group kind of sponsored plan, do you guys have anything else from a DI offering standpoint?
We do. In fact, it's been interesting over the course of time, from my perspective, to see how some things have unfolded for us. Back in 1992, during the AIDS epidemic, the student section of the AMA brought to the House concern about disability coverage and the threat of maybe a needle stick ending their career before it really even started. And at that point in time, medical students, no income, there was no disability coverage even available. So we brought this to the House. The AMA explored the feasibility of it. And in 1992, we brought to the table the first disability coverage available to medical students. And so that's an example of looking out into the market, the needs specifically of physicians, and trying to design something unique for their specific situation. And just to give you a feel for the pricing of something like that, very, very inexpensive. So it's $48 a year per student. So basically next to nothing. In many cases, medical schools will purchase the coverage for their students. It helps them meet different accreditation requirements, but it's been a very, very successful program and a very, very important program. Right now, we probably insure 1 out of every 2 medical students in the United States with this particular plan. So that's probably the most important example, in my opinion, of us bringing to light a new product.
Well, you guys paved the way on that because now every carrier has the option to insure a medical student for a certain amount, a couple $1,000s. They don't have a set income, but that's very interesting.
Yeah,
I know you guys still kind of have a hold on through your program there. Most of the students are wrapped up in that, but all the carriers now have that as a thing. So,
and we view that as a good thing because at the end of the day, the important part here is that students get covered because they do have a risk, and the amount of money they spend on medical school in the event something were to happen, it can be catastrophic. In fact, we have an example, from a couple of years ago. We insured a student, young, healthy, 24-year-old, fourth-year medical student, had a tragic accident, fell down a flight of steps, and was paralyzed from the waist down. Couldn't finish his fourth year of medical school. Our benefits kicked in, helped him kind of reset to his new normal. Now, the good news is he was actually able to make his way back to medical school, completed his education, completed his residency, and is actually a practicing physician right now. But it's just an example of the need that these young students have. You never know what might happen.
People in general look at disability as like the hit by the bus scenario, but that's not necessarily the case, and especially for physicians who are highly specialized individuals and have spent 4 years in undergrad and 4 years in medical school, another 4 years in residency. What it allows you to do is that scenario, that story you just told, is a lot of times they're such highly driven individuals that they want to stay in medical field. So like, let's say you were going to go be a surgeon and something happened and you lost use of your hands, but that doesn't mean you have to leave the medical field. You can change paths and get a different specialty and at least see patients in a practice setting. And having that benefit allows you to make that pivot, really. And I think people miss that. They're like, oh, if I can't work, I'll get a benefit. But it actually provides a lot more flexibility in you continuing to work in a field you love, because they'll pay you for not being able to perform surgery, but yet you can go work in a teaching hospital or see patients on rounds, stuff like that. You're still getting income for what you were going to do, and now you have that time and resources to pivot. So I think that's a very undervalued look or miss at what people understand about it. It's
an important point. In fact, if you think about how motivated these young professionals are to continue down their journey, we've actually tried to make sure that we have benefits associated with our disability products for those younger students and residents that actually provide a benefit to help them stay in school or stay in the residency program before they might go on a disability claim, because we know how motivated they are. And so we've made a really important effort to try to bring those kind of benefits to the table to do just what you said.
We've been partnered in the marketplace for close to 15 years now, right? So, and you guys have your kind of unique set products that you're doing and stuff. But I think one of the things maybe, Matt, you could comment on is, working in this disability space, working with the insurance companies to kind of find niche offerings to complement what the AMA is doing in their insurance agency. You talk about some of the things we've done in the past with different products and different solutions to complement what they're doing.
Yeah, absolutely. So, Mike, your guys' product encompasses a wide swath. But over the years, we've had specialized discounts outside of the product, a couple different carriers under that. We've moved that program. So what we've done on the Millennium side is we have been able to fill the gaps that you guys couldn't cover on your end. So maybe that's somebody with a health issue or somebody making a large salary. I mean, there's some surgeons out there who we've worked with who make $1.5, $2, $3, $4 million a year. And that doesn't fit in a normal disability bucket with any carrier, really. So over the years, we've stepped in to help fill the gaps, had some discounts, worked maybe some multi-life programs. Really, we've been here to fill what your program did not fit. And then probably one of our most successful areas would be, unfavorable underwriting scenarios. We've had a lot of people, call you guys and you kick them over to us where they have the type 2 diabetes or they're over 60. The over 60 market has gotten huge. I get one of those every couple of weeks. They're like, I'm 62, 63. I've decided I'm going to practice into my 70s. I need more coverage. So that specialty market over 60, maybe some health concerns, nothing major, but when you factor in a little age and some health concerns, your normal core carriers kind of are not an option anymore.
Not everybody fits into one product.
Right.
Yeah.
And so the ability to offer other options, we go back to choice and making informed decisions and things like that. With our goal, we want to help physicians. And so if our product isn't the right fit for them, the partnership we have with you all allows us to extend that choice and to help serve the physician. And that's been very, very important for us.
I can probably count on one hand how many times we've not been able to get some sort of offer of coverage. If the person is, under age 70 and it's in a reasonable scenario, I'm only thinking of 2 or 3 that have been complete denials. Now, it carries a price tag, but if you're looking to work into your 70s, we can figure out a solution on the disability front.
With my kids being where they're at, in college, just finishing up college, they've got a lot of friends that are entering kind of the world of being nurses. And that's a tough curriculum.
The Social Security Administration says that 1 in 4 become disabled. 25-year-olds become disabled before they retire or reach 65. And if you think about the career path of healthcare professionals,
Sure.
nurses, doctors, and the stress, the physical strains, you would think that might even be more than 1 in 4.
If you were to take all of our topics and kind of summarize those into 2 or 3 bullet points as kind of as a closing specific to the physician marketplace and AMA insurance, go ahead and tell us what those would look like in your perspective.
Take the steps to make an informed decision, number 1. Number 2, it's important to take action sooner rather than later. Even if it's not the perfect step, something's better than nothing. And then the third takeaway to me is once you have some things in place, your lifestyle, your life is going to continue to change and evolve over time. It's critically important that you continue to reevaluate what you have so you can think about how to continue to take care of yourself and your family, not just from a physical health standpoint, but from a financial health standpoint.
We appreciate you as a guest. We appreciate you as a business partner and look forward to many years to come.
Well, thank you, Jason. Thanks, Matt.
Thanks,
I
Mike.
appreciate the opportunity to be here.
Absolutely.